So we'll just jump right in. First question I have for you all is around terminology, because there is a lot of terminology in this area. Broadly, how would you define ethical investing, and what terms should people be familiar with in this area, such as SRIs and ESGs? Sucheta, perhaps we can start with you on that one.
Yes, definitely. I think what we're seeing now, especially if you're reading the mainstream media, is the most common use is ESG investing, which is environmental, social, and corporate governance, ESG, small c, capital G. And what that means is that an investment manager is looking at metrics relating to those three areas when they are choosing their investments. But there's, I think it's a little bit agnostic, because when you look at those metrics, you can give them any sort of weighting you want, which can range from very minimal weighting to very hefty weightings. So when you go back in time and you look at socially responsible investing, SRI, which is what I focus on, there's a little bit more of a moral weighting, where you're saying, these are things we want. We'd like to invest in these things in order to build a better world. And these are things that we are going to exclude. So there is a what's called a negative screening aspect to socially responsible investing, where there are typically exclusions around tobacco, military, nuclear, and certainly other ethical issues like factory farming, humane treatment of animals, worldwide slavery. So I think it's important for people to realize that right now there's a lot of terminology, and some of it is very general. So if you see a term like sustainable, it could mean anything. So it's important to dig a little bit deeper and see what that product or that fund manager is doing, what they mean by sustainable or responsible.
Great, thanks. Claire, Kelly?
If I could jump in, I think with the SRI, that really grew out of the specific requirements of a number of types of institutions, primarily, I would say maybe 20 years ago, to be avoiding certain types of companies. And this is where the negative screening started. I'm thinking particularly of religious institutions that maybe had some very specific requirements around gambling, or I mean, I'm trying to think of a stock that's involved in pornography, but alcohol, all sorts of things like that. And of course, there's actually quite a big group of strategies which have been developed around the whole kind of Sharia, conditions around banking and interest payments, etc. So it kind of started from that, but of course, it's that is only excluding certain types of companies. And the ESG to me seems as if it is looking more broadly. Maybe sometimes it's a combination of the screening and then a combination of scoring. But on ESG, you can then score companies on all types of grounds and then kind of develop a portfolio around that scoring. So I think the ESG has the potential to be a broader application than the SRI, which seems to be about individual screening. And obviously you can combine the two. So you can decide, okay, there are these things we definitely will screen out, and we won't have anything in those particular sectors or those particular business activities. And then maybe combine that with ESG, which is using scoring to then say, and of what's left, what will we tend to overweight or underweight, or will we remove things that are particularly high on some measures, but not remove everything. And I think things like carbon metrics, so environmental metrics, really lend themselves. Some of the social metrics, governance metrics like women on the board, is there a separate chairman? So some of those types of metrics really lend themselves very well to the ESG, and they wouldn't really work with the SRI, if that's making sense. So I think that's been part of the evolution, realizing that SRI was only going so far, and it wasn't looking across the whole market and providing any kind of criteria to take into consideration that you could look at a stock and try and sort of position it or rank it on a combination of criteria.
Yeah, and to build on what you just said, Claire, for your viewers, you may want to look at the Farm Animal Investment Risk and Return think tank. They work on ESG ESG metrics specifically focused on factory farming. And I think this began about 2016, at which point they said that ESG investors broadly are looking at fossil fuels, climate change, but few have focused on animal agriculture and its various environmental impacts, but also its social and governance risks. And FAIR, as it's called, has done a great job of setting up a framework that's by the ESG, within the ESG framework, and really mapping out what these risks involve, how they score companies against them. So I think that, again, for your viewers who are looking at learning more about ESG risks, specifically in animal agriculture space, that's a great resource. And I also wanted to call out differentiating between ESG investing and impact investing. So whereas ESG, SRI, this may focus mostly on exclusion, though there are some impact investment opportunities in the vegan space now. Impact investing involves more venture capital, seed funding, angel funding, investing in disruptive technologies, products, and services that you believe are going to help transform an industry in a way that you want to see it transformed. So just want to throw that extra bit of terminology in there.
That's helpful. I think a lot of people stopping by, even myself, I'm supposed to have some kind of background in this area, but it helps to have these things clarified because that confusion is common. All right, great, thank you. So the second question I have for you guys is around expectations. So how should investors calibrate return expectations in the realm of ethical investing? Should they be expecting to generate a lower return on their capital because they're including an additional constraint in the investment process that other investors don't have? Claire, you're smiling, so we can start with you.
I really hate this assumption or criticism around ethical investing, which I think, was much more current, let's say 10 years ago than it is now. The data that there is out there actually shows that applying these kind of criteria or some kind of ethical screening or scoring onto portfolios and then using those criteria to select the stocks has actually been pretty successful. I mean, it's happened quite a bit in the long only space, but I also used to work as a hedge fund analyst, and I even saw hedge funds who are kind of perceived to be, amongst the most kind of, least ethical of investors, and the most kind of hard-nosed about, is this going to work or not? Actually bringing these kind of criteria into their programs as well, because they had looked at the data and they had seen that the performance was there, that good governance did tend to lead to better performance of the company overall, which translated through to the profits and to obviously the returns of the company, including more women on the board. There's data around that. And in terms of the environmental metrics also, you could take the environmental metrics of a company and just say, is this a representative of, let's say, their efficiency in using resources? Obviously, from the standpoint of what I've developed, there are certain things that we in our program believe we shouldn't be using as resources. We're avoiding fossil fuel completely. We're avoiding animal exploitation completely because we don't see those as being resources that should be being used. But what we've also found is that there is pressure for companies to be moving away from using those resources. We all know that companies, we can't be burning fossil fuels in the way that we have before. We all know, I think a lot of us know, that we should be reducing our use of animals for numbers of reasons. And obviously if you're a vegan, then you're completely opposed to it. And that in itself is an increasing number of the population. So I see this criticism of being, well, you are restricted from buying certain stocks as saying, well, what are your actual expectations for those stocks that you're restricting? Are we going to be burning more fossil fuel? Can we afford to? No. Are we going to be using more animals? Is the meat industry going to be larger and smaller or smaller? I can create or formulate investment theses around why the bets that we have within the Vegan Climate Index will actually perform. And we better hope that they do perform. Because if you created a portfolio around all our exclusions and then said, this is the portfolio that's going to perform, you'd be looking at a pretty horrible world in 10 years' time. So that's my response, is that I fully expect and hope that there will be performance from ethical funds, because I don't want to live in a world where there isn't.
Sucheta?
Yeah, I call this the zombie myth, the myth that won't die. It appears that no matter how much data we have, how many research papers there are that show that you don't sacrifice performance when you invest responsibly, it's still one of the first things that we hear from people is, oh, well, you know, I'm prepared to give up performance in order to have a better world, but you really don't need to at all. And I think we now have a significant number of academic papers, as well as papers done by people within the financial industry. And we also have what are called meta-analyses, which are papers that analyze all the papers that are out there. And they are all basically showing that while you might not today, and I am agreeing with Claire that this might change in the years to come. So today you're not getting outperformance from investing responsibly, but you're not sacrificing anything. And with respect to real world examples, MSCI has an index called the ACWI, the All Country World Index. And over many years, leading right up to August 31st data, the ESG leaders ACWI has matched or just very, very slightly outperformed the non-ESG leaders, the traditional ACWI. And I think that just shows from a purely financial standpoint that you don't sacrifice returns at all to invest this way.
Great. Kelly, anything to add?
Yeah, I would just echo everything that Claire and Sucheta has said, that the studies are there, the proof is there. And to your point, Claire, about a world in which ethical portfolios, so-called ESG, truly ESG graded portfolios that are aimed at creating a better world, to the extent that they do perform, the world will be a more livable place. To the extent they don't perform, it will be less livable. It is that basic at this point. I think that the reality of climate change is making these decisions imperative. This is not, we want to feel good about what we do, though we may. It's we need to put these screens in place. We need to think about what these technologies are going to mean by 2050 is one standard, but there are even sooner than that. So I think that the more that climate change becomes a reality, the more that other environmental impacts, including those caused by factory farming, the more those become investment risks, the clearer and clearer the thesis that my co-panelists have put forth is going to bear out. So I encourage everyone again to educate themselves on what the risks look like. It can seem like a complex web, but once you begin to learn about what companies are doing, what the risks are, the information is out there and becomes more digestible. And again, I just encourage everyone to learn as much as possible.